largest domestically owned contract food services providers, Rassense has reported a 29% revenue jump to 471 crore rupees, while serving more than 3.25 lakh meals a day across factories, campuses and corporate parks. From investing in AI-led operations and robotics to rolling out one of the most inclusive employee ownership models in the industry, Rassense is betting on scale, governance and technology to power its next phase of growth. To tell us what's driving the company's expansion, its roadmap to 564 crore rupees in revenues, joining me now is Sanjay Kumar, the Managing Director and CEO of Rassense. Sanjay, welcome to Startup Street. Now, like I mentioned earlier, Rassense has reported a 29% year-on-year jump to 471 crore rupees in FY25. What were the biggest growth drivers this year, and what is the current valuation of the company?
Thank you very much, Shruti, for having me on this show. To the two questions that you just asked, well, the growth driver was partly because of the initiatives that we put in place, but there was also a crying need in the market for an Indian company to work professionally and deliver contract food services across the country. It's ironical that 78 years after independence, India still is in a situation where no Indian companies even got listed in this space.
Yes.
So the market was expecting, that sooner or later somebody comes into this space. So we kind of were there at the right place at the right time. And I think that has helped us in driving growth.
Okay.
But additionally, if you see, the economy also has done well because we serve the sectors which essentially are consumption driven. So manufacturing is our core, focus area. And that's picked up really well in the last, 2 years.
Yes.
And we believe that it will continue to grow. So that's been the other driver. And of course, the fact that because we believe that the business is no longer about food, that technology will play a very important part in what happens in this sector. And we invested significantly in that space. Yes. Where the differentiation could then be visible to our customers.
Oh, and what's the current valuation?
Well, if you look at the market valuation in terms of what the current multiple on our stock market is, we would come in at 1x revenue. But it's anybody's guess, as you know, you can't predict the markets and you can't run ahead of them. Our basic focus has always been to build a strong, robust business. Within 2 years, we are profitable. We generate free cash of about 1.2%, so we don't burn cash for growth. Okay. And that will continue to be our focus, even though a significant part of our revenue goes in investing in technology.
Yes, yes. And picking up from what you just said, you currently serve 3.25 lakh meals a day across, factories, corporates and institutions. So, Sanjay, tell us what ensures client stickiness in such a large-scale, low-tolerance environment. And you've also maintained a 3.6% EBITDA margin. So how do you balance operational efficiency with quality at scale?
Partly. And also, we have let go of our ambition at times. There's always a desire to get more revenue, but we have had to measure, do trade-offs of revenue versus margin because we are not, a large multinational and our competitors are amongst the largest in the world. We are like a rounding off error on their balance sheets. So what's helped us is keeping this semblance of order. At the same time, to your question, what has helped us survive is moving away from the same story about responsiveness, availability, to actually making visible difference by using technology.
Okay.
When I say that, it is right from the production process down to consumption. So how we buy raw materials, we have our own digital platform around that. How we build recipes by using the data of 7 years that we have on SAP, linking that to the consumption, which means how does waste correlate to the recipe? And trying and seeing whether there are tweaks there to bring down wastage, because that's the contribution then we make to the environment as well as to our margins. So it's much more complex than I thought it was when I started the business. But yeah, I'm beginning to learn.
All right. So, in fact, you've invested 2% of your revenues in tech. And thanks for sharing with us how you've automated or optimized your kitchens and supply chain today. But you are targeting revenues of 564 crore rupees next year. What are the new verticals, regions or partnerships that will drive this next phase of growth? Are you looking to diversify beyond institutional catering, towards food tech, supply chain optimization, or even meal analytics as platform?
That's a very good question, and it's it's very tempting to want to do more beyond what your core business is. But we have to keep reminding ourselves that let's not jump the gun. So let's first do what we are good at and do that well. Alongside that, continue to invest in technology. You'll be, happy to know that we've just copyrighted a digital technology that we deployed for material tracking, which is the first time in the world. This is not about India, that a material tracking tool has been developed, which we have already deployed across the country, where we produce these 330,000 meals.
Sure.
Now, you can argue that, in the rest of the world, material rejection is not significant. But in India, it's important because we focus on buying local produce so that we reduce the carbon footprint.
Okay.
And if you have to do that, you have to invest in technology to track what you're buying real time. So within 1 hour, across our sites where we produce 300,000 meals, we know the quality of our raw materials.
Sure. We're pressed for time. Very quickly, you've rolled out a share dilution program for employees, extending equity to site-level managers, something far more inclusive than traditional ESOPs. What impact has this had on productivity, retention, and culture? And also, I believe you have plans to raise some funds. If you could quickly answer these questions.
Okay, the rollout of ESOPs is something I personally don't believe. So we have actually given OCPRS, which is shares, because ESOPs, you never hit the target price. This is way much more, secure than that. This is the first time in India since it became a country that a food service company has given OCPRS or shares to employees. And in terms of future, we do get a lot of interest from both strategic investors and funds to want to invest in our business. But we believe we've already had one round of debt raised for the leveraged buyout, which was the first in the country, which was with Spark Capital.
Yes.
But for now, what we are thinking is that we will look at the next round more towards adjacencies to our core business, as also on in terms of inorganic, so that the business does not lose sight of the fact that free cash is important at the end of the day, no matter what you do.
Absolutely. And on that note, I'll have to wrap up our conversation. Many thanks, Sanjay, for joining us on Startup Street, and wish you the very best with all your growth plans.
Thank you. Thank you very much, and all the best to you as well. Take care.